Have you ever asked, how do I understand my FICO score? In this video, I'm going to talk to you about your FICO score, also called your credit score, and how to better understand it. Welcome to Your Clear Thinking. I'm Roderick Mitchell, author of Credit Straight Talk, Clarity on the Conspiracy. This video is part of a series of videos designed to help you build a solid credit foundation. Your credit score has 5 parts that make it up. The parts are the payment history, percentage of credit used, new debt accumulation, age of credit, and credit mix maintained. Part 1 is your payment history, which is the most important part of the 5 parts. It makes up 35% of your credit score. Your credit history tells the prospective creditor what kind of payment performance to be expected from you. On-time payments, which were discussed in the previous video, label you as paid as agreed, which is the best rating that can be given to you by a creditor and a reporting company. The more items you have listed this way, the better. This does not mean that everything went perfectly during the life of your previous financial obligation. What it does mean is that your creditor was satisfied with your performance and that there was no reported negative activity associated with the collection of payments by the creditor. Next is part 2, percentage of credit being used. It is the second most important part, and it accounts for 30% of your credit score. This part of the credit score is also referred to as the credit debt ratio. The credit debt ratio explains how much of your current available credit is in use and to what degree. In the credit debt ratio model, the same amount of credit owed on a credit account can be rated differently, even when the interest rate is the same. In an example, I will explain 2 similar accounts, account A and account B, and I will point out what I was saying. In account A, the balance is $2,500 with an interest rate of 10% with a credit limit of $5,000. The credit debt ratio is 50% with half of the credit being available. In account B, the balance is $2,500 with an interest rate of 10% with a credit limit of $7,500. The credit debt ratio is 33% of your credit is being used with a 67% availability. Example B is the most favorable for a credit debt ratio. Because higher credit limits on fewer accounts is better than lower limits on multiple accounts. Even if the total amount of credit is the same with matching interest rates. You should understand the credit debt ratio for it to work properly as an advantage to you. And remember to periodically ask for a credit limit increase and lower credit interest rate, at least once a year. Part 3 is the length of your credit history. It is 15% of your credit score. In the credit score evaluation, mature credit is considered an older account that has regular activity with a good credit debt ratio. You are considered a low risk and strong performer with preferred customer status. New credit is automatically considered weaker because it has no supporting history or performance, either good or bad. That means the higher risk is built in, meaning higher interest rates, longer application process, and lower credit limits, and no preferred customer status. Part 4 is new debt accumulation, which makes up 10% of your credit rating. New debt accumulation is a delicate mix, and it should be monitored regularly to avoid excessive amount of new accounts being opened. Because in the credit world, a high number of open accounts is viewed as erratic, and it's also interpreted as the kind of thing people do before they're getting ready to overload those credit accounts and then just bail on everything. A high number of inquiries have a similar effect as the aforementioned account accumulation. You should check your credit report yourself before attempting a credit purchase to eliminate the need for multiple inquiries and surprises. Remember, it is better to regularly increase the credit limit on your account, as explained previously. The last but important part is the credit mix. It's also 10% of your credit rate. The preferred mix is a low interest rate mortgage, a vehicle loan, and 3 low interest, high limit credit cards, all in good standing for at least 1 year. And a credit card that just sits open with no activity for long periods of time actually work against your credit rating because they are considered dormant. Dormant meaning, in the credit world, sitting frozen with no activity. All of this previous information makes up your FICO score, credit score, and it is represented by a numerical value. And there are a total of 5 different versions of your FICO score because each major industry has its own. And by major industry, I mean the auto vehicle industry, mortgage industry, bank card industry, installment loan, and then there's the general score. And the score most used is that general score because it is a collection of all of the aforementioned industry basics, and it covers all type of credit. That's why it's called the general score, just like the old general store. Okay. You got high, medium, and low. And the value of that score is expressed in points. The high range, which is the best, is 700 to 850 points. The perfect score of 850 is not very common. A more realistic credit score is, say, 760 to 820 points, which is well received by any potential creditors. High-range credit scores are considered low risk for the creditor, and you will be offered a low interest rates because they are confident in your past performance. The next credit range is medium, which is 620 to 699 points. Medium range is considered average risk, meaning that you are likely to pay as agreed, but there may be problems along the way. Your interest rate will be a little higher, making your purchase more expensive. And just for clarity, did you know that the majority of credit age adults in the United States fall in the medium range? Just because of real lack of understanding of credit. Some of the other reasons: overextension of credit, erratic employment and interruptions, and just misunderstanding of credit. The average risk associated with medium credit score range is common. The last and lowest credit score range is 619 points and lower. This credit range will have you with extremely high interest rate. And because you would be considered a risk of not paying, or just bailing and trying to keep the merchandise. Your payment agreement is going to be very expensive when compared to the actual value of the item that you are trying to purchase. And remember, anything you purchase in an extremely high interest rate, it should be an absolute necessity just for the penalty that you're going to have to pay in interest. Otherwise, use cash if possible. A situation like this is also a candidate for credit repair, because proper credit repair could clean up or remove bad credit history before any major purchase. When your credit rating is in this range, remember, any improvement will be welcomed, because the lower the credit score, the more costly it would be. In this video, I talk to you about understanding your FICO score. Subscribe to my channel below and select the playlist to see all the videos in this series. Visit my blog, yourclearthinking.com. I'm Roderick Mitchell, author of Credit Straight Talk, Clarity on the Conspiracy,